ഇന്നേ ദിവസം വളരെ സന്തോഷകരമായൊരു രണ്ട് കാര്യങ്ങളുണ്ട്. ഒന്നാമതായിട്ട് ഡയസ് ഇൻവെസ്റ്റ് 2007 സ്റ്റാർട്ട് ചെയ്തത്. ഇന്നേ ദിവസം 500 കോടി എന്നുള്ളൊരു മൈൽ സ്റ്റോൺ ഞങ്ങൾ ക്രോസ് ചെയ്യുകയാണ്. പിന്നെ അതോടൊപ്പം തന്നെ എടുത്തു പറയേണ്ട മറ്റൊരു കാര്യം എന്താണെന്ന് വെച്ച് കഴിഞ്ഞാൽ ഇന്നേ ദിവസം ഇപ്പം നമ്മളുടെ കൂടെയുള്ളത് മഹേന്ദ്ര മനു ലൈഫ് മ്യൂച്വൽ ഫണ്ടിൻ്റെ CEO ആയിട്ടുള്ള ആൻ്റണി സാറാണ്. അപ്പോൾ സാർ ഇന്ത്യൻ എക്കണോമിയെക്കുറിച്ച്, അതോടൊപ്പം തന്നെ ഇന്ത്യയുടെ ഫ്യൂച്ചറിനെ കുറിച്ച്, ഇൻഡസ്ട്രിയെക്കുറിച്ചെല്ലാം സാർ ഒന്ന് എക്സ്പ്ലെയിൻ ചെയ്യും.
Yes, okay, sure. No, so I'll start with, and I'll try to keep it simple. And first, let me congratulate you again.
Thank you, sir.
On a milestone, 18 years.
Yeah, 18 years.
18 years is a long time. So you have become adult today.
Yeah,
in some sense,
yeah.
the business. So to my mind, and I'll just focus primarily on equity. Sometimes we are guilty of, I think, complicating our lives. One of my favorite dialogues I like to give is that you want to become a successful investor in equity, you need a high level of EQ, and you ideally need a low level of IQ. Because when you have high IQ, you tend to read every news article, every event, and overanalyze. And so you don't end up doing what is the right thing. You only end up in your mind making up all kinds of conclusions. This will happen, that will happen. But the reality, and I keep telling people, you look at the evolution of the industrial revolution, then the digital revolution, etc. Only one thing has remained constant, because we've moved from steam engines to electric engines, we have moved from internet to AI, but 1 plus 1 is still 2. In the last 200-300 years, 1 plus 1 is still 2. To my mind, equity investing also, the key elements of equity investing remain the same, which is that you should remain invested. The thing that makes you money from equity is time. That's the primary message I would like to give. Firstly, anybody who has given time to his or her investment in equity is normally the person who has made money. Anybody who has given IQ to their investment in equity, more often than not, ends up complicating the result. If you take that as a holy truth or holy gospel, let us say, put it that way, then I think just very simplistically you think about it this way. There are only two markets in the world. India is one, the US is the other, where maybe it is because both are very large democracies, because both are capitalists, both are free economies, etc., where there is a very, very clear correlation between the growth of the economy and the growth of the stock market. So if you were to make a graph for last 20 years, 30 years, 40 years, you will find that the line of economic GDP growth and the line of equity market returns, especially when you cross 10 years, 20 years, it's almost like it's the same line, right? It is, a lot of people take it for granted, but it is not the case. I mean, to give you a counter example, in China, they have grown by nominal GDP terms, because that's what you have to look at, by something like 15-16% in the last 20 years. Actually higher than the US and higher than India, but the equity market has delivered a compounded growth of 5% in that period. So only India and the US have been able to reflect the growth of the economy, because you just think of it very simplistically, and I'm kind of dumbing this down because it's actually as simple as that. If you are a company, and you are a company that obviously is there to make profits, you will make profits based on the environment you are part of. And for a company, that environment at a starting level is the economy, right? So if, let's say, you have an economy that is growing at 6-7%, then you have inflation which is on average 4-5%, then logically everything in the economy has grown by about 11-12% over a period of 1 year, 3 years, 5 years, 10 years, 15 years. And you will be hopefully, or maybe you are arrogant enough to say that if I am a company, I am much smaller than an economy, so I should be nimble, I should be able to grow slightly more, right? Now, it's not like every company will grow slightly more, but if you are a good company, you will say that if the economy is growing by 12%, maybe I have the right to grow by 1-2% more, right? And so people sometimes spend a lot of IQ, like I say, to predict that whether Nifty at 26,000 is expensive or not, whether the Sensex will cross 100,000 in the next 2 years or not. But it's easier to say, do we all have the conviction that Indian economy will grow by 6.5-7.5% over the next 5 years? On that, people will have a lot more conviction. Whether Sensex will hit 100,000, whether Nifty will hit 35,000, there are lots of confusing things. which sectors, which subsectors, all of that. But if I have to ask everybody in this room, are you convinced that the economy will grow by 7% or thereabouts over the next 5 years? People will say yes. If the economy grows at 7%, are you clear that you are going to still pay more and more for every item you purchase over the next 4-5 years, which is called inflation? The answer is sadly yes. So if the nominal GDP growth in the next 4-5 years is going to be 10-11%, let's take that as an example. And if you know that for the last 20, 30, 40 years, the nominal GDP growth has eventually got reflected in the equity market, then effectively you can take a very strong conclusion that the equity market will grow by 12-13%. Now 12-13% over 5 years, if you just do simple math, means you will double your money. So my simple base case is that if I told you today that there's a very strong reason for you to take your money and double it in the next 5 years, would you do it? The answer is yes. But the challenge for investors is that they spend so much time thinking about tariffs, geopolitics, gold, this, that, and the other, that you forget that basic premise. And I often tell people that us fund managers are very guilty. We make 35-slide presentations, talk about so many things. Ultimately, it boils down to the first slide, which is if this country is going to grow from a $3.5-4 trillion economy to $7 trillion in the next 5 years, then the market cap, which is 4.5 trillion today, will grow to hopefully 8.5-9 trillion. Now, the beauty of markets are there are things called sentiment, there are things called liquidity, which means that it will either double in the next, let's assume if the economy doubles in 5 years, either you will double your equity money in 4 years or 6 years, because it is not such a perfect correlation, right? And you should not worry about that. Since I'm in Cochin, I will not probably be able to use this example, but I give people in Mumbai this example, which is an example of cinema. You know, now at least a lot of movies have different plots, but if you go back 20-30 years, every movie, at least in Bollywood, I think Malayalam cinema and South cinema, at least there are many new plot lines, but if you go back 20-30 years, the story is same. It starts in a good note, then eventually there has to be a villain, there has to be some issues, and once those issues, you know, at the end there will be a happy ending. Eventually there will be a happy ending. Now the reality is, just think about this way. You went into cinema hall, if every minute of the movie was exactly happy only and it was moving, you will probably leave in the interval saying, boss, this is what a horrible picture. You need twists and turns. But the challenge is, and so therefore everybody goes to a movie knowing what the ending is going to be. It's going to be a nice ending, 90% of the time. But all of us still go and watch the movie. And we watch next Friday, we go for the next movie. Why in equity we do it differently? If I'm telling you that the ending is happy, that it is going to double in the next 5-6 years, why are you not able to stay in the theater? Why does the interval come every 20 minutes or 30 minutes and people walk out and have popcorn, which in our parlance is they will redeem, they will switch, then they will think, oh, this is now maybe not a good time, things will happen. So that I would say is the fundamental premise any investor should keep. And that is what I meant by saying right at the beginning, right? The best thing you can give an equity investment is not your ability to analyze global markets, economy, it is your ability to control your emotion. And when you control your emotion, what you will end up doing is you will give your investment time. And that will be the key ingredient. Now, since Primson will kick me out if I don't give a view on the market, I will still say this, but I will say that whatever I'm telling you is just what we see in the markets today, right? In fact, I have a slide that I use when people talk about markets. They talk about the positives. You know, the positives start with what are the positives for India, what are the positives for specific sectors, etc. And then there is a slide which will always say these are the risks. Right? Because all us fund managers are very used to ending presentation with a standard dialogue. Any of you can deny this dialogue, then I'll be happy to contest it. But if you have attended 100 presentations from equity fund managers, it ends by saying that in the long term we remain positive, in the short term there could be volatility. That is the standard dialogue. Now, in that context, I kind of reverse that argument and I say, okay, what are the kind of risks that are there? And you put a slide up which will say that there is geopolitical risk, there is economic risk, liquidity risk, credit risk, etc. There are some 7, 8, 9 risks. I can personally tell you, and I've been investing in markets for the last probably 31 years, that at any point in time when I looked at the market, there were 2 or 3 risks that were there at that juncture in time. So to believe that in this market there are risks, it's the first ever time risks are there, is a very foolish assumption. Ultimately, if God is giving you an ability to create wealth, it's not a one-way ticket. That one-way ticket is going to come with, if you take the risk, then you will ultimately get the return. And so therefore, on the element of the various risks in our market, all I will say is that at the end of the day, the only cure for all the risks also ends up being the same point, time. Because in time, people find a way to deal with the risk, right? Coming to a third aspect, which is what is the story for India? Why will India look, are we taking the doubling the economy in the next 5 years for granted? If you think about the evolution of our economy in the last, say, 30, 40 years, one of the key elements I think that is very different today is the clear recognition by the policymakers that manufacturing will have to play a much larger role in the next 5-10 year story of our markets. It then therefore means that what we spend lot of, again, IQ on, which cap is better, small cap or mid cap or large cap, which sector is better, I think is a very dangerous or a very time wasting thing to do. Because the reality is, when you have an economy that is likely to grow at 7-8% or maybe 11-12% nominally, it will mean that in every sector there will be winners and then in every sector there will be losers. There will not be the ability to say this sector avoid, this sector you must buy. And our view is therefore in the next 5-7 years, it's very, very important to spend your time and energy buying what you believe will be successful companies rather than successful sectors. Right? I can give you one very simple example. This is in the way we construct our own investment philosophy, which is fairly similar to lots of others. Let me be very honest. Everybody puts a very fancy term on the name of the philosophy. We call ours GCMV, which is we believe that we buy companies, or we'd like to buy companies that have a growth story to them. We'd like to believe that when a company is in a business that is growing, what differentiates a successful company from a not so successful company very often is the people running it, which is the management. So that's the M of GCMB. We also believe that at the end of the day, if you really want to thrive, you need to invest more in your business. Therefore, cash flow becomes very important. So therefore, a business that is more cash generating rather than just showing paper profits in a P&L, we would prefer the high cash flow business. And the fourth is valuation, right? At the end of the day, we are doing this on December 1st. Black Friday sales have just happened, right? How many people in this room have gone and made a purchase on Friday? Yeah, because it's available at a discount in your head mentally. Okay, after next Friday, I'll urge you to take a deep breath and think about whether you actually needed it. Right? And then you'll discover that at least half the things you bought you didn't need, but because things are available at a discount. So obviously, even in equity investing, you want to have a margin of safety. To me, investing in equity and being good at it is hopefully getting these 6 out of 10 times right. If you do that and you're able to size the positions right, money is made. But beyond this, one of the things that we believe is very important, especially in the India context, is what we call catalysts. Catalysts can be both positive or negative. It's nothing but a very fancy English word to describe something that has changed. And that something that has changed can sometimes propel a business higher, or it can sometimes propel a business lower. And the reason why we think it's very important is because if you are in an economy that is doing well and everybody has in some ways arguably equal opportunity, what you then sometimes can make a lot more money on is calling what we call the balance of trade. Now, let me give you an example. What do I mean by balance of trade? I mean that there is in that ecosystem, and in fact, one of the best examples you can actually give, I don't want to make this more technical because I know there will be investors listening to it and they will be saying, he said no IQ, but he seems to be pretending as if he has a lot of IQ. But you just think about, and since I come from the Mahindra group, let me take cars as an example, right? One of the core raw materials that go into making of a car is steel. Now, ultimately, there is 100 rupees per ton of profit that is being made. There will be a point in time when the balance of trade or the balance of power is with the car manufacturers. Okay, and it is not with the steel manufacturers. There's a lot of steel, not enough cars. So the 100 rupees of profit that is around will be with the car company. And there will be times when there is a deficit supply of steel and then the balance of power is with the steel company. Now just think about it. Commodity companies like steel typically trade at a P of 10. Discretionary companies like auto trade at a P of 25. So sometimes it's the same 100 rupees, but the same 100 rupees in the market is valued at 250. And the same 100 rupees is sometimes, not 250, 2,500. And the same 100 rupees is valued at 1,000. And what we believe is trying to understand these catalysts as to where the balance of power is shifting is an important thing. It's true in every sector you think about. Take banking, for example. When interest rates come down, what happens? All of your EMIs hopefully get reset lower, but banks can't reset the deposit rate that much lower because they need liquidity, right? The same is the alternate. When interest rates are going up, what happens is your loans rates go up pretty much the next month. But it's not like they're going to pay you, if they're paying you 6.5% deposit, they're not going to pay you 7, right? So they will pay it probably after 3 months and 6 months. So broadly speaking, as long as you do this kind of investing consistently enough, and you are doing this, like I said, in an economy where the opportunity is to double, you will make money. Now comes to the point of why should we not also look at other products? Why are we only discussing mutual funds? For the simple reason, to be honest with you, is that, and like I said, if I restrict this to equity, the reality is today making money in equity, like I described, if there is equal opportunity, if the situation is going to be dynamic, there will be catalysts that will keep happening, they will keep changing. The question you have to ask, and I'll say this is not even a question you have to ask the investors who will watch this. I think it's a question we as advisors have to ask ourselves. Do we genuinely have the time and expertise to be actually tracking that? And if you say yes, then I would deeply question the commitment and time you give to your own job. Because I can do either of the two, right? Either you give complete dedication and passion to what you do, which is advising clients. And if that is the case, where do you have the time? Now somebody said, no, I have an uncle who is very, very rich. He has made a lot of money in market. He tells me what to buy. And I'm like, that is brilliant. But what guarantee you have that when your brilliant uncle knows that this is the time to sell, do you believe you're lucky enough that a family dinner happened just at that time? So he happened to meet you and say, Arey, remember that stock I told you? I hope you sold it. What will happen is typically 4 years later, you'll say, uncle, you told me this stock, it was 100, it went to 600, now it is 50. And he'll be like, I don't have it. Why you have it? So, investing through tapes, investing when you don't have the time, investing when you probably don't. In fact, I hesitate to use the word expertise, because let's put it this way. Every fund manager is a human being, and every human being, let's be honest, is identical. They are swayed by emotions, they are doing exactly the same thing. The only thing I will therefore substitute the word, say they don't have more expertise, but they have more experience. Right? And because they have more experience, more often than not, you kind of have this memory in your head saying, I've seen this before. And so the last time I acted and I reacted and it cost me, so this time that experience comes in and I will not react or I may not act, right? So I would say that's the combination of why, if you are looking to create wealth, buying a diversified equity fund is the simplest thing to do. I would also go further to advocate only one more product, and I think it's very apt to discuss it in this part of the country. And I will first put a slightly cynical point of view that, like I said, I've been in this industry for 30 years. And obviously part of my day job is to go around meeting many clients and many advisors and so on and so forth. And so in the last 30 years, I would have done thousands of such interactions. In the month of October, as a consequence of those interactions, I got more questions on gold and silver in 1 month, at least twice in that month, than I had got in the previous 30 years. Okay, so it just kind of tells me that unfortunately we also fall prey to what is the flavor of the moment. And one has to remember that very often flavor of the moment has at least a 50% chance of not coming through in the next 1-2 years. But that being said, I would say that one of the other products that I think investors should look at beyond equity funds, which the mutual fund industry has created a lot of in the last 2 years, are multi-asset funds. So you automatically get an exposure to gold and silver, you get an exposure to fixed income, you get an exposure to equity where there will be some model which is kind of adjusting it based on the market valuations, etc. And that's probably the easier way for you to have your allocation to gold and silver. So the way I argue is that actually every investor should have at least 10 or 15% of his and her portfolio into multi-asset funds. If you have, let's say, arguably 20% in multi-asset funds, then you automatically will have 2, 3, 4% in gold and silver anyways. And over time, these products will become even more, I would say, diversified. Because some people, in fact, in our own fund, we have been debating and arguing that, and these are now possibilities, why don't we look at buying crude futures? India is at the end of the day a very oil dependent nation. At some point in time, if crude is going to go up, perhaps, and we have that view, we want to play that particular scenario, you can actually buy an exchange traded commodity derivative, regulations, approvals permitting, and so on and so forth. So I'm just going to end this by just a very, very simple message that the most challenging part about making money in markets, sadly, is that it is one of the most boring jobs possible. It is really a very boring job. It's because ultimately it's like you have to give it time and you have to ignore any event that happens in the middle. Nothing can get more boring than that. Everybody, you're a human being, everybody needs a little bit of excitement. You need something to happen, right? There is a very human emotion that says, I'd like to see this double. When something becomes half, you get panicky, right? Those things are part and parcel, you're used to it. But the reality is that as long as an investor and as advisors to those investors, you're able to make sure that people do not either overreact or not react, but just make sure that when they invest in equity, invest in a diversified fund over the next 5-7 years, like I started, if the economy doubles, there is a fair chance that your money will also double, as long as, like I said, you have the patience.
I have a question.
Yes.
We undergo many exams to qualify to advise the investors or
Yes.
educate the investors, right? So many apps itself, customers can invest. Okay,
Yes.
without any advice or awareness, it will help them or what? What is the specific?
It will help them only if you believe you have spent enough journey in investing in funds that you have made at least 5 or 10 mistakes, so you know what not to do. And again, I come down to, do you really have the time? You may, in this particular case, believe you are in. First of all, a lot of investors think they have the expertise, but they don't. A lot of people would think that, okay, I want to do this myself. I go to an app, it's very easy, tick, 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 I'm done. But there are, as an industry, we are damn good at creating complication. I discuss simplicity, but as an industry, we are complicated. We have 3,000 odd schemes. So you want to invest, actually, you just need to invest in, let's say, 5 or 6 multi-cap or flexi-cap schemes. How do you choose broadly those schemes? Very often what you'll do is you'll start saying, okay, I'll click descending order of last 1 year performance. Now remember what I said, if the market is dynamic, things will keep evolving. It will evolve from this year rewarded value, next year rewards momentum, next year sometimes rewards growth. At the end of the day, more often than not, you will end up doing what was great just in the last 12 months. Some of it will work out, some of it will not work out. And my biggest argument is, what are you doing that for? Some people say, I'm doing that because it's direct, it's cheaper. And my question is that, cheaper by what? Cheaper by 0.25, 0.5%? Are you willing to compromise your future, your family's future for 0.5%? Right. I discussed Black Friday, right? Did anybody buy something on Black Friday because it was cheaper by 0.5%? The answer is no. They bought it because it was 20%, 30%, 50%. So if it is 20, 30, 50, then yeah, sure, go and do something directly, immediately. But I personally wouldn't want to compromise my life for 0.5%. Right? It's like I was just telling Joby on the way, and please excuse me, I fortunately I'm not yet coughed, but I've sniffled. So I was just telling him, and of course, this hypocrisy, right? I'm just answering you this, and I'm doing exactly opposite. So 2 weeks ago, I got a cold and a cough. So what do we do? I'm like, I've had this cold before, so I will take a Febrex. I know how my cold typically progresses. Everybody does. Everybody's cold is very individual to them. They know how exactly it gets worse and then how it gets better. So after 1 week, it did not get worse, it did not get better. So then I had a eureka moment. Again, see, I've not gone to advisor, which is doctor in this case. Yeah. I believe I know it. So this is not cold. Then I jog by and say, see, 2 years back and 3 years back, twice I happened that it was not a cold, it was an allergy. Doctor had detected. So I am not joking. I picked up my phone with, that time fortunately it was COVID. So you had to tell the doctor by video. So I had the prescription on my phone. So I'll tell you, it's a real true story. Bilasure M. So I walked out of my office, I went to a nearby chemist, I bought Bilasure M, and for next 5 days I had Bilasure M. And nothing changed. Finally on Saturday, which is day before yesterday, I went to the doctor. And he said it's a respiratory infection, it is not an allergy and it is not a cold. And so I told him, doctor, I'm here, I'm going to Cochin and I'm also at a group offsite. So I'm going to be back next Saturday. So can you give me medicine for 7 days because, I'm not going to be. He said, no, I'm giving you medicine for 4 days. It will be fine. Trust me. Now just think about it. I should have done this 2 weeks ago, no? But I instead chose. So that's the difference. If you want to do this yourself, you can decide to achieve the same thing in 2.5 weeks, or you take the help of a trusted professional, you can do it in 4 days. Thank you, and keep doing the work you guys do. No, I genuinely mean this. Advising customers the right way, you can actually consider yourself social workers. That's the reality. That there's a lot of social good that comes from us being able to do this job in a right way. The key word is right way, right? And that's the beauty of our business, right? If our customer's wealth grows, that's when he will say 500 has become 1,000 crores. How will 500 become 1,000? 500 is not his wealth. One day it may be his wealth, but 500 crores is the wealth of his aggregated customers. Yeah. If you are able to do wealth creation for your customers, then 500 becomes 1,000 very quickly. And like I said, I did talk about this, but in some of the other sessions, I do mention this, that and I'm very careful to talk about it because it should not be in the nature of very tall promises, because it's just a philosophical belief. It's not a belief anchored in financial reality. But if you read history books, if you read philosophy books, there is a lot of articles and writings about how in any nation or civilization's history, the period of maximum prosperity for its citizens is when that nation moves from developing to developed. Okay. It basically will argue that actually maximum prosperity for all citizens do not happen when a country is developing. When a country is developing, you will always have inequalities and stuff. Neither does it happen when it is developed, but it happens in that time. And I can't help but thinking that when we talk about Viksit Bharat as the objective, right? I mean, that essentially is that journey. So effectively, we are very, very fortunate. All our customers are very fortunate that we are living in that period of potential maximum prosperity. So if there's any time to be optimistic, just give it time. This is the time. This is it. Not just for the next 5 years, but frankly for the next 10, 15 years. Because our children will not have that opportunity if history is anything to go by. Because this history has absolutely no exception. Whether you look at South Korea, you look at Taiwan, you look at Japan, you look at Singapore, countries closer by, you just capture the prosperity creation in those nations when they move from developing to developed. It's a very different time. And this is hopefully our time as well. We'll see. Anyways, thank you so much.
Yeah.
Thank you.